World equity markets continued their upward trend over the past month, albeit at a moderating pace, with Indian markets also participating. The US Federal Reserve cut rates by 25 bps to 3.75% to 4.00%, citing emerging softness in the labor market and reiterating that future policy action will remain data-dependent. Meanwhile, the US government shutdown stretched to a record 43 days. Although the economic impact appears limited, the absence of key data releases contributed to subdued market activity. On the trade front, tariff concerns have come full circle. The US-China relationship has shifted from confrontation to a more managed, framework-based truce, supporting sentiment around global growth and risk assets. Discussions on a trade understanding with India are also reported to be progressing, with expectations of a near-term conclusion. In India, high-frequency indicators such as auto sales, GST collections, and UPI transactions for October 2025 point to a healthy pickup in economic activity, particularly consumption. Sustaining this momentum is critical, as the October to December quarter will be the real test for the various government and regulatory initiatives aimed at reviving demand, as highlighted in last month's Alpha Strategist. Corporate earnings so far have largely been in line with expectations, with the upgrade to downgrade ratio improving steadily for the last 2 to 3 quarters, now at 0.7, signaling ongoing earnings recovery. FII flows turned positive after 3 months, while DIIs continued their steady participation. At the same time, robust domestic flows and a heavy pipeline of IPO supply have acted as a cap on near-term market upside. While India's macro and earnings backdrop remains constructive, portfolios anchored solely in domestic markets risk missing out on global leadership themes. As investors reassess allocations amid evolving global dynamics, international exposure is becoming a valuable complement to India's long-term structural story. Reasonable valuations in select markets, coupled with rising institutional interest, further strengthen the case. Investors may consider allocating to large, stable economies such as the US, emerging markets, the EU and Japan rather than taking overly granular bets. The relatively low correlation of these markets with India also enhances diversification benefits. Within India, several emerging and high-growth opportunities lie beyond the Nifty 50. The recent rally has been narrow, only about 30% of BSE 500 stocks have delivered positive returns over the past year. In such an environment, generating returns above baseline calls for active management and exposure to high-growth sectors. Overall, in the prevailing environment we suggest to look beyond borders and baseline, adding exposure to other geographies and seeking opportunities beyond index-heavy exposures to enhance long-term, risk-adjusted returns. The temperature gauge index remains in the fair value zone. US market climbed, 6th straight monthly gain, on strong big tech results and a second Fed rate cut with tough stance on path ahead. However, the 10-year is still around approximately 4.1%, still a headwind to flows to India. Last month manufacturing momentum stayed strong, GST collections were healthy despite rate reduction indicating strong economic activity. It was risk-on for India with equities rallied approximately 4 to 5%, with FPIs becoming net buyers after 3 months. Domestic demand and capex looks on track for approximately 6.5% growth. As stated earlier, consumption wave looks good in India due to GST reform, rate cut, above-average rainfall, rate easing, income tax rationalization and the 8th pay commission. The first month of the quarterly result is in line with expectations so far, leading to improvement in upgrade to downgrade ratio. While long-term structural growth story of India remains intact, one should add exposure to other major economies as well to participate in global growth led by emerging trends and to diversify. Index is expected to deliver in line with India's nominal GDP growth, but faster compounding is sitting outside the benchmark selectively. Moreover, given the concentrated rally in the market, one should look for active managed bottom-up strategies. Equity view, neutral. Portfolio allocation, 50% allocation to large caps, 10% to global and 40%, 5% overweight, allocation to mid and small caps. Investment strategy: lump sum investments in hybrid funds at current levels. For pure equity-oriented strategies, a staggered SIP/STP approach over the next 3 months is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. The yield curve has steepened this financial year, with the 10-year and 1-year spread widening from approximately 5 bps to approximately 70 bps. RBI's liquidity measures have eased short-end yields, while subdued institutional demand and elevated SDL issuance have kept long-end yields firm. We believe there remains room for policy to remain accommodative, supported by moderating inflation and global uncertainties. Yields are likely to stay range-bound in the near term. We continue to favor accrual strategies across the credit spectrum, along with income-oriented real assets. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. Select InvITs, REITs, NCDs for a period of minimum 3 to 5 years. For less than 3 years holding period, one may allocate in relatively liquid fixed income alternative solutions like arbitrage funds, minimum 3 months holding period, income plus arbitrage fund of funds, minimum 2-year holding period, hybrid SIF funds, minimum 2-year holding period, conservative equity savings funds, minimum 3 years holding period. Gold and silver prices consolidated over the past month, with silver displaying higher volatility. We reiterate that sharp, near-exponential price moves in any asset class warrant caution in deployment. While gold, silver, and broad commodities tend to perform well during phases of currency weakness and growing deglobalization amid geopolitical tensions, new allocations should be approached through a disciplined asset allocation lens.